And we're live. Good morning and welcome to Coffee Talk with Sked and BBoss Online. My name is Amanda Kelly. I am the Small Business Training Director for the Southeast Kentucky Economic Development Corporation. And with me, I have Kyle Smith, who is the Small Business Training Specialist. You want to say hi, Kyle?
Hello, everyone. Nice to be here. Excited for today. It's going to be a fun topic. Should be interesting to hear. Amanda is going to be doing most of the teaching today, but we'll give everybody a few minutes to go ahead and get on before we get started, and then we'll roll on.
Excellent. Thank you, Kyle. I'm afraid to click any buttons that I might screw something up. So, oh, Jen's on. Hi, Jen. Good morning.
Awesome. So we've got one person. Let me get to our live video if you don't mind.
Yep, no problem. Take your time. Take your time.
Looks like we've got 4 people on right now.
Excellent. Is the video showing up okay?
The video is working. They can see the top of my head right now because I was looking down, but good morning from Moorhead.
Good morning, Rachel. How are you?
Cool.
Thanks for joining us.
We got a few people on today. And, yeah, go ahead and explain kind of why we're doing today or kind of.
Yeah. So today we're going to talk about your financial statements. If you use a CPA or an accountant, hey, Suzanne, how are you? If you use a CPA or accountant, they probably hand you at the end of the month or at the end of the year a stack of financial statements. And what I've found through the years of working with small businesses is while they like getting these statements, they may not fully understand what each one means and how they fit together and why they're important. So with COVID, obviously, a lot of businesses have taken a huge hit on cash flow and other areas as well. But I think having a stronger understanding of your financial statements makes your business stronger. So we're going to go through the big 3 today. And I've got a PowerPoint for you, so we're going to do things a little bit different than we have in the last couple of weeks. Hey, Tony, how are you? But let me see if I can get this PowerPoint to pull up properly and get it to work. All right. Kyle, can you see my screen?
I can. So they haven't seen it yet because, of course, we're on our delay, but they will see it by the time that it transfers. But yes, it looks like your screen is showing correctly. You're in the upper right-hand corner of the monitor and should be ready to go.
Excellent, excellent. So the big 3 financial statements are your balance sheet, your income statement, and your cash flow statement. The income statement has a number of different names, and when we dig deeper into that financial statement, we will explain what all the different names are. I don't know if they do that to confuse people or what the reasoning is, but basically your balance sheet is a photo of your business. It's a moment frozen in time that can change drastically moment by moment depending on what you have coming in and going out. So this includes your accounts payables, your accounts receivables, and depreciation of your assets. It also shows your assets, what you own, and your liabilities, that's money that you owe other people, and working capital or capital, owner's equity is another name for it, that is inside your business. After we finish with the balance sheet, we're going to talk about your income statement or your profit and loss statement. This shows your business's performance. It shows your income and your expenses over a period of time, and it shows net profit or loss over a period of time. Last, but certainly not least, is your cash flow statement. This shows you how much money comes in and how much money goes out of your business. It only includes your cash transactions, and it shows cash received and paid. This is not the same as accounts receivable and accounts payable. So I've got 3 resources for you, and Kyle's going to put in the comments on here a link to a Dropbox folder that has all 3 of these resources in addition to the full PowerPoint. So don't worry, we're going to go through this a little bit fast, but you will be able to access all 3 of these resources in addition to the PowerPoint, in addition to being able to go back and watch the live video. So basically the 3 resources are your small business report card, managing cash, and understanding where you stand. These are 3 really, really great resources that we picked up from the SBDC, and they have some extremely valuable information. I really recommend that you not only look at them, but print them off and read them thoroughly. Because like I said, I'm going to hit the high points today, but there's deeper information in each of these. So your balance sheet has 3 sections. It has your assets, your liabilities, and your equity. The assets are the things that your company owns. Your liabilities are obligations to pay or provide goods or services later. And your equity is the amount of net assets, which are assets minus liabilities, owed to the owners of the business. This is also called owner's equity. There are a number of different terms that they use to describe that. But your total assets have to equal your liabilities plus your equity. That's why they call it a balance sheet. It has to balance. So, go to the next slide. Your assets include both current and non-current assets. Current assets are typically things that are going to be either our cash or are going to be turned into cash within 12 months. Non-current assets are things that your business owns that you don't anticipate turning into cash in the next 12 months. So your current assets will be your cash, your inventory, and your receivables. Your non-current assets are going to be things like your furniture, fixtures, property, equipment, anything that your business owns that it doesn't intend on turning into cash in the next 12 months. Your liabilities also have current and non-current. Current are due within a year and have to be paid within that time frame. Non-current or long-term liabilities are due more than 1 year out. So if you have a loan on a building, more than likely it's going to be a non-current asset because you're going to pay it over a number of years. Your capital or net worth is your owner's investment, so the money that you've put into the business. And it can also be your retained earnings. This is income that is kept inside the business instead of putting it out to the owners. What your balance sheet shows us are the net value of the business. It tells us how much debt the business has, both current and non-current. And it also gives us numbers to talk about, to look at ratios. And we're going to look at that towards the end of the presentation. We're going to talk about 3 different ratios that you can use to help determine the health of your business. It also allows us to compare time periods to see changes in cash, accounts payable and receivable, equity, inventory, and retained earnings. So you can look at your balance sheet every 12 months or every month or every quarter to see what's changed in your business. The balance sheet is a very important document, but it doesn't tell us everything, which is why we need all 3. So your balance sheet does not tell us income or expenses over a period of time. It does not tell us the market value of assets. So if you built a building and it is appreciated and become more valuable, that will not be reflected on your balance sheet. Contingent liabilities. So if your business has co-signed a loan for another business, if that business fails, you're going to be on the hook for paying the loan. Your balance sheet does not reflect that. It also doesn't reflect any operating lease obligations. So if you are renting your facility, your balance sheet does not take into account the fact that you owe rent because that's not an asset. So your balance sheet does not reflect that. The next one I want to go over is your income statement. This is also known as your operating statement, your earnings statement, or your P&L or profit and loss. So again, there are a lot of names that explain the income statement, but they're all the same document. Your income statement tells you things like how much money you're making. Typically, this would be looked at monthly, quarterly, and annually. This is something that you need to keep an eye on pretty frequently. We use it to produce predictions about how the business is going to be doing in the future. These numbers are super helpful if you're trying to fill out one of those pesky business plans and you're trying to do projections on what the business will do in the future. Your income statement is going to be a valuable document in figuring that out. Your income statement shows us whether or not sales are up or down. It talks about your gross profit, and it covers your expenses for a period of time. And then it also shows us how much money was left over after you paid those expenses. What it doesn't show us is the overall financial condition of the business. It doesn't cover everything. And you'll hear me say this multiple times, but you can't just look at one of these statements and understand how well your business is doing. It really is something that you have to look at all three of them because they all tell us different things. And then when we use the ratios, we'll start tying these numbers together to figure out how your business is doing year to year, but then also how your business is doing in compared to industry averages. Your income statement does not tell us what's tied up in accounts receivable and accounts payable. It also does not tell us what you own or what you owe. So you can't just look at your income statement and say, oh, I'm making money, I'm good. I wish it was that simple, but it's not. So the income statement shows us some really valuable information, especially when it comes to sales and expenses. So income and expenses, because it shows us it's something we can look at monthly to see if sales are up, sales are down, see if we're spending more to produce our product or service, things like that. Oops, I jumped, sorry. All right, your cash flow statement. This is one of the most important things to keep a really close eye on, especially dealing with what we're going through right now with COVID and some businesses being closed or only open partially. Cash flow is critical to businesses. Arguably, it's the thing that will make or break a business faster than anything else. If you don't have the cash flow to keep your business afloat, it doesn't matter how much money you're making. So our cash flow statement tells us what money comes in and what money goes out and what stays. The cash flow statement deals only in cash. That's the only thing that it covers. It tells us if the business can cover day-to-day activities. Do you have enough money to make payroll? Things like that. Tells you whether or not you can pay your debt on time. Tells you if you can maintain or grow the business. It shows you if you need more working capital in the business. It also tells you how big of a loan payment you can afford each month. It also breaks down your principal and interest. And it shows you if there's a weakness in the business of either generating or keeping cash. Cash is, like I said, cash is one of the very most important things, especially when you're starting a new business. You've got to make sure that you've got enough cash to cover your expenses. And that's both operating expenses and overhead expenses. What your cash flow statement does not tell us is how much we have tied up in accounts receivable and accounts payable. Balances in assets and liabilities and net worth are not covered on your cash flow statement. Again, this only talks about cash. It also doesn't cover the depreciation of equipment, which is a non-cash expense that's found on the balance sheet. So I think you're probably starting to get a good idea of why each of these is important and why you need to look at all three of them. I'm going to pause for Kyle. Do we have any questions or anything?
We don't have any that have shown up yet. I did leave a comment that says anyone has any questions, feel free to ask them. We can keep rolling, or if somebody wants to pop up with a question, we'll wait for a minute or two and give you a chance to take a break if you want to.
I'll take a drink of coffee since we're on coffee talk.
But yeah, so I've put the link out there for the Dropbox file that you created, and I'm sure we'll talk more about, we'll put the link out there again, but that has, copies of today's PowerPoint. It has, does it have examples of all the files and stuff too?
It has all three of the resources that I talked about on that second slide. So they're all in PDF. You'll be able to download them and print them. So, and those three documents are where I got the vast majority of the information that we've put in this slide. They're really solid.
Cool. And I think you said those are from our partners at the SBDC?
Yes, that's where we got all three of these documents, from the SBDC.
If I'm not mistaken, we have an SBDC employee on the live right now.
I believe we do. So go ahead.
If she'd like to chime in with a comment or something, or, we were more than happy to help that way too.
Absolutely. And, at SCED, we work really hard to help all of our clients and all the businesses in Eastern Kentucky. But the SBDC does that as well. They help with the business plans. They really help a lot with projections, and they can help you understand your industry averages. So sometimes when you're looking at your statements and your ratios, you're not sure if you're doing well with where you should be in your industry. The SBDC is an awesome resource that you need to utilize to get some of that information.
Yeah.
So, all right. So Kyle, just interrupt me if a question comes in, but I will keep plugging away at this. On your screen right now, you can see we've got a balance sheet, an income statement, and a cash flow statement. And I've got all of these arrows pointing in different places to show you how these numbers fit together on each statement. So for example, on your balance sheet in the cash column, that cash number comes from your cash flow statement. That's your ending cash balance. So that number goes directly into your balance sheet. Your net income goes straight down to owner's equity on your balance sheet, coming from the income statement. From your income statement, you pull the revenue and expenses, and those go into the operating activities on your cash flow statement. Your financing activities go into long-term notes and owner's equity on your balance sheet. And your investing activities go into plant and other on your balance sheet. So you can really kind of start to get an idea on how all of these numbers fit together with each other. These are not three separate statements that use different numbers. They all work together to give us a full picture of how our business is doing. And I'll be honest with you, I think it's a great idea to print this slide so that you've got this graphic and kind of can take a look at it when you're looking at your actual documents, because it'll help things make more sense and click for you. So once we kind of understand what each individual statement does, how can we learn from these numbers to improve our business? We use ratios for that. Ratios help identify strengths and weaknesses in the business. They can be used to compare your business to industry averages and year to year to see trends, to see which direction you're heading in. Your numbers for your ratios are taken from the income statement and the balance sheet. We don't pull any numbers from the cash flow statement for your ratios. So I've got three ratios that I want to cover. I think these are three of the more important ones. They're all important, but I think if you're going to start to look at these, I think these are three that you need to start with. So you've got your accounts receivable turnover ratio. Not all businesses have accounts receivable. If you are a restaurant and you simply serve people as they come in and they pay as they go out, you're not going to have accounts receivable. But if you have a cabinet shop and you are building cabinets for new homes, you're going to have accounts receivable. And the speed at which you collect those receivables greatly affects your cash. So from our balance sheet, we're going to pull our accounts receivable number and we're going to multiply it by 365 days. Then from our income statement, we're going to pull our net sales. So first, we're going to say that our accounts receivable balance is $10,000. We're going to multiply that by 365 days, which gives us 3.65 million. And then we're going to divide that by our net sales, which is $50,000. If we do the math, that tells us that it takes us 73 days to collect our accounts receivable. So if we take our accounts receivable balance, $10,000, and we divide that by 73 days, it is costing us almost $137 per day to hold those receivables. If we could manage to collect those receivables 20 days faster, so in 53 days instead of 73 days, it would add an extra $2,700 to our cash. So I don't know too many businesses that wouldn't be important. Collecting your accounts receivable faster makes a difference in your cash flow. It makes a difference on whether or not you can pay your loans, whether or not you can pay your employees. So keep that in mind. Pay attention to your accounts receivable turnover ratio and figure out how many days it's taking you to collect. The next ratio I want to cover is your current ratio. This is your ability to pay your short-term debt. Both of these numbers are going to come from our balance sheet. We're going to take our total current assets and our total current liabilities and divide them. So for this example, we've got just under 900,000 divided by about 541,000. If we do that math, it gives us a number of 1.65. Ideally, we would like to see this number at 2 or higher, because that would mean the company has twice as many assets as it does liabilities. If you've got twice as many assets as liabilities, it makes it easier to pay your debt. We can improve this ratio by collecting our accounts receivable faster, like we talked about on the first ratio. We can also look at increasing our profit margins by raising our prices and selling more. So you may find that your current ratio is lower than it should be. Look at your accounts receivable, see if we can collect those faster, but then also look at increasing your profit margins. So figuring out a way to make more per product or service that you sell. The last ratio I want to talk about is the profitability ratio. This is your company's ability to make a profit. Now, both of these numbers are going to come from our income statement. So we're going to take our net profit divided by net sales. So if our net profit is 171,000 and our net sales is just about 4 million, we do the math and we get 5%. Every industry is different. Some industries have a very high profit margin. Some industries have a very low profit margin. So depending on the industry that you're working in, there's no perfect number here that you're trying to hit. You want to stay within your industry averages. For example, a jewelry store would have a higher profitability ratio than a gas station. That's just the nature of those two businesses. So understanding what is common in your industry is important here. Otherwise, you don't really have anything to base it on. So the higher the percentage, the better, obviously. And you can increase this number by raising prices, lowering your cost of goods, and lowering your expenses. This is an important ratio to look at probably quarterly and definitely annually. If you look at it and see that your profitability ratio is going up every year, that's a great thing. But if you see that your profitability ratio is slipping each year, it might be time to really take a good, hard, long look at your expenses and your operating costs, your cost of goods, and see what is crept up that's keeping your profitability ratio down. So these are good benchmarks for you to take a look at and judge how your business is doing year over year, month over month. So what we've learned is basically your balance sheet is a photograph of your business frozen in time. It can change drastically if you get a new loan, or if you pay off a loan, or if you collect a large accounts receivable account. Your income statement is basically your business's report card. It's an overview of how well things are going. And your cash flow statement talks about what money comes in, what money goes out, and what money stays in the business. Your ratios are the grades on your report card. It's how you gauge how you're doing against the past and other businesses within your industry. So all four of these components fit together to give you a solid picture of how your business is doing year over year, month over month, but also overall, and gives you something to compare it to within your industry. So at Sked, our tagline is "Let's do business better." And on this last slide, I have put both my information and Kyle's information on here. I've found from experience that a lot of times when you're handed your financial statements, folks are afraid to ask questions. They don't want to appear like they don't know what's going on in their business. Asking questions is probably the most important thing you can do, because the better you understand these three statements, the better you can operate your business and make better decisions to grow your business. If you're not comfortable asking questions here on Facebook Live, that's absolutely okay. All you have to do is either email or call Kyle or myself, and we'll set up a private meeting with you, and we will go over every question that you've got. There is absolutely no stupid question when it comes to your financials. The more you have a handle on this, the more your business can grow and reach the goals that you've set for it. So please don't be afraid to ask us questions, even if you don't want to do it on Facebook Live. That's okay. But ask the questions. All right, I am going to stop sharing my screen. And
absolutely. While we're waiting to see if we got any more questions pop up, I want to say we missed a couple of good mornings. So
yes.
Good morning to Sabrina, and hopefully I don't butcher this too much, Chris. I think I got that right.
Yep, you did. You did.
Then, Chris said that you're doing a great job at explaining this. I completely agree. Then Rachel made the comment that she learns something new every day, and having someone else present it is a great way to learn.
Thank you, guys. I appreciate all of that. This is personally my favorite part of taking a look at a business is the financials. You can learn so much from the numbers, and I can sit there and stare at spreadsheets all day long, and I'm perfectly content. But not everybody has that defect. So it's normal to hate this part of running a business, and that's okay as long as you understand it. You can have your CPA produce all of these documents for you. And as long as you understand what those documents are telling you when they give them to you, that's perfectly acceptable. I think that you can do you can learn so much about your business that you didn't realize you didn't know by taking a look at these ratios. I'd say that there are a lot of businesses out there that have accounts receivable that they're not real sure how many days it takes them to collect on average. And just paying attention to these things and keeping them in focus will make you improve them. You're absolutely right, Chris, that it's essential to understand this, to gain that strategic insight for your business. If you're trying to figure out whether or not you should expand to a second location, you can take a look at these numbers and you can make that determination. It's vital that you do that before, look before you leap kind of situation. You want to make sure that your business can handle and support what you're trying to do. So, yeah, I agree. Those ratios are worth their weight in gold and can make decisions. Business decisions should never be emotional. They should always be fact-based. And by making business decisions with your financial statements, you're going to be making fact-based decisions. These are not made-up numbers. These are not numbers that we're just guessing at. These are your real numbers. And they can give you the real insight as to whether or not this is a good time to grow your business, or maybe it's a good time to pull back a little bit and shrink your business. So, does anybody have any questions, or is there anything that I missed that would, you feel is important for us to talk about?
Yeah, and I just wanted to say, I appreciate you going over this. We kind of brought this up last week, and it was one of the voted on options in the poll that we put out. And I know this is one of your favorite things to do, and one of the things that you enjoy a lot. So
it is. I do love when we have cash flow day when we're teaching smarts. The more simple you can keep things, the easier it is to understand. And we go through a great exercise when we're teaching smarts, talking about a pie factory, that somebody wants to start a pie factory or start making pies at home and sell them. And when we go through the entire math process of taking how much they want to make versus how many days they want to work, it comes out to they've got to make and sell like 43 pies a day to make $20,000 a year working 6 days a week. I don't know that anybody loves baking pies enough to be willing to make 43 pies a day, 6 days a week, 52 weeks a year, and have that be worth $20,000 to you. So by going through those numbers, you've determined that business as you've thought it through is not going to work. But if you look at selling pies by the slice, that's a way that business could possibly work because your profit margin per pie is so much higher. So this allows you to run your business on paper before you invest all of your money and do it in real life.
Absolutely. And that's always an important thing to do. We've not got any more questions right now. I do want to ask, what are the plans for next week?
I was just thinking about that. I don't know. We are going to go to ProTrade on October 1st and do Coffee Talk from there, because we are going to be doing a live drawing with ProTrade that day, because they are giving away a Blackstone flat top grill.
Oh, okay.
I know. I'm kind of excited about that. I don't know how many of my own entries I'm going to have to accidentally drop in that bucket, because, everybody knows I need more grills. But so we're going to do that on the 1st of October. So I really do need ideas on what we should talk about next week. Do we want to go deeper into cash flow and understanding how to do projections, things like that, we could certainly do that. We could talk about anything.
If we're going to go into cash flow and, deeper into that, I think the idea you just mentioned of the pie factory, or the, selling pies, I think it'd be a fun one to bring up and just kind of show it. You mentioned it, but you didn't mention it, and you didn't show it today, and it's fun exercise to see for sure.
It's a good exercise. And then we also have another one just talking about cash flow. And it's a super simplified version of how cash flow works in a business. And we can cover that exercise as well. I think they're super valuable, and I think they put things in perspective in a way that's easier to understand than just looking at your financial statements.
Looks like we got one vote for yes. So
Chris says yes, so we can do that next week.
Okay.
And I'll do the same thing that I did this week, where I put things in a Dropbox folder so that you can access them later. We'll put some additional resources in there to kind of help you if you're looking to start a business, to help you figure out how cash flow is going to work for your business and figure out your projections. So a lot of these resources that we use, we've picked up from other locations, and a lot of them came from the SBDCs. We've pulled some from SCORE. So there's lots of information out there. Sometimes it's overwhelming because you don't know which information is good. So we've kind of vetted everything, and I feel like we've got a pretty strong amount of resources. And, it might be a good idea to put a lot of those handouts that we used in Smarts on our website as a resource, Kyle.
And we can do that for sure.
Yeah. That might be helpful to folks.
That's not a hard thing to do. We can handle that.
Yeah. So if anybody has any other thoughts, comments, questions, we'll hang out for a couple more minutes. But I certainly appreciate you joining us for this Facebook Live, and I really appreciate all the comments. Those really do help while we're doing these, because it's kind of like me and Kyle talking to each other.
Pretty much. We're pretty good at that. But yeah, these are pretty fun to do and fun to have for sure. And we appreciate everybody tuning in and just, listening and interacting with us.
Absolutely. And I'm getting more comfortable with the idea of being on Facebook Live. It was something that I've not wanted to do for a long time, but it is getting easier. So if you're thinking about starting to do Facebook Lives for your business, the first couple are rough, but it definitely gets easier.
Oh, for sure. It's funny. I've mentioned going live and the importance of Facebook Live and stuff to businesses for 2 years now. And I'd mentioned we need to go live 3 or 4 times, and finally got to.
Thank you, COVID. Yeah, I agree, Chris. I do think that it would be important, a good thing to go over what investors are looking for, what pitch decks look like, and what information you need to understand about your business when you're going to an investor or a bank for that matter. Obviously, the more you can answer questions off the top of your head, the more your investors and or bankers will have confidence in your ability to run this business. So absolutely, I agree. Tony, I appreciate you joining us.
Absolutely, thank you. But yeah, it's been a pretty good coffee talk. I feel like.
I think so. I hopefully, all the businesses out there find it useful and can take something away from this that improves their business, because that's really what we're trying to do. And again, I can't stress it enough. If you want to talk about this offline privately, and we can sit down with you and your financial statements and go through them and make sure that you understand them before you make your next big decision. So, all right, guys, thank you, Rachel. I appreciate you joining us.
And Rachel, before we get off here, if you want to leave your contact information in the comments, you are more than welcome to. And I know we got Sabrina with SOAR here as well. So
yeah. Yep, both are awesome resources for businesses in Eastern Kentucky. The SPDC, I've already said it does great work. SOAR does great work. So if both Sabrina and Rachel will put that in there, that would be awesome.
But no, I mean, and we'll be back next week with another coffee talk and ready to go. Like I said, I'm looking forward to starting our coffee talk on the road program that we've been discussing and teasing a little bit, and we'll see how it goes.
Yeah, so we've got a couple of weeks open between, next week we'll dig deeper into the different exercises you can do. But if you've got an idea of a business that would like to host us to do Coffee Talk Live at that business, we would love to make that happen the following week. I think we might even have one more week in there before we go to Pro Trade.
Yeah, let's see here. Yeah, we've got 2 weeks 2 weeks after next, so we could do 2. But we'll see where it goes.
Yeah, absolutely. Thank you, Rachel, for putting that in there. Sabrina may have had to have hopped off, but if anybody needs Sabrina's contact information, I can certainly get it to you. I believe her email address is just Sabrina at soar. Is it soar-ky.org?
Let me see if I got it.
I think that's what it is. Going off memory.
Yeah, Sabrina at soar-ky.org. So
cool. I'm gonna stick that in the comments here. Sabrina at, whoops, I can spell. There you go. So definitely don't ever hesitate to reach out to SCED, to the SBDCs, to SOAR. We all want to help. And, the more we can help you grow your business, the more that helps the economy in Eastern Kentucky grow. It's a snowball effect, and that's what we're trying to accomplish. Well, I hope everybody has a wonderful rest of their Thursday and a great Labor Day weekend.
Absolutely. Goodbye, everybody.
Bye, guys.